February 23rd, 2024. Whenever you get a gap up, I always try to pay a lot of attention to the prior day's high because that's going to be a support point and a potential open gap. Like yesterday, you can see the first open gap we had was with yesterday's high, and then we ended up getting the second open gap in the trend day. And so whenever you get that gap up, you have to be paying attention to if traders are able to keep the gap open, because a lot of times if they are, you'll end up getting a swing up in potential trend day. But I thought overall today we were really overbought on the daily chart. So I was expecting something disappointing from the bulls. Generally after a bull trend day, 75% chance you're going to get 2 hours of sideways to down trading starting by the end of the second hour. Bull bar on bar one closing near its high, but not all that great. I think I'd rather wait and see the follow through, and then you get an inside bar, bar two. So bad follow through for the bulls. Do you sell below two? Probably not. It's a high one for the bulls, and the bears are hoping it's a bull trap and that we're going to get a swing down to at least yesterday's high. Bull bar closing near its high on bar three, but why wasn't it consecutive bull bars with bar one? And why does bar two exist if we're about to go up? Why did we get bad follow through on bar two? If bars one and three were right after each other, it'd be better. But I think that three could potentially just be a second leg up from one, so it's not a very good buy. When we got four, I thought that it's a low two short. And in an area that's relatively overbought. So it's maybe an okay swing, but the channel from 1 to 4 up is pretty tight. So it's pretty hard to want to sell 4 unless you're hoping it's high of the day. I thought this was another one of those good situations where you could say that it's probably, I don't know, maybe 40% chance that that's the high of the day and you get a big swing down, which it ended up being kind of similar, I thought, to bar 2 yesterday. Low probability low of the day, low probability high of the day. And you end up getting bad follow through on 5. Why do you get bad follow through on 5? Because, it's a tight trading range 2, 3, and 4. And you don't really want to sell that low in a tight trading range. And for that same reason, it's bad. Bar 5 is not a very good buy. If you're buying bar 5, you're buying a third leg up. 1, pullback, 2, pullback, 3. So buying bar 5 is buying a third leg up at the top of the tight trading range. And you're so far above the moving average at this point. Do you really want to be paying this far above average price for this kind of bullish price action? If you're paying for price action well above the moving average, you want well above bullish price or well above average bull price action, like bars, 1, 2, 3, really good bull bars closing near their highs. You want things like that rather than, this sidewaysness. And that's what causes bar 6. Bar 6 tests the low of the day and gets bought back up into the tight trading range. And what do you notice? There's something really important that's going on right now. Bull bar, bear bar, 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 right? So the first 10 bars alternated closes every single time, which is a huge red flag for taking any sort of trades. You really don't want to be trading if you're doing this, or if the market's doing that. So 6, big bear bar, but bottom of a trading range and got bought up. 7, an inside bar, bulls hoping that essentially it's a double bottom with 1 and a micro double bottom with 6. And then they get a swing up and a measured move, but I'm going to bet that they're going to get bad follow through, and it never triggers. Inside bar 8. It's an II pattern, but do you really want to sell below 8? I don't think so. I think I'd rather wait for follow through at this point. We have so many alternating closes that traders are expecting the alternating closes at this point. So less trader, worse probability for everybody. Outside up on 9, but a big tail on the top. Essentially triggering the buy above. It triggered the sell below and failed, and then tried to trigger the buy above. But again, we're within a tight trading range. So I'm not doing anything. 10, a bear bar, but a big tail on the bottom. Bears hoping essentially spike, pull back, lower high, some sort of reversal here. I think their target is yesterday's high. Kind of poor follow through on 11, a doji bar, but the doji bar is a bear close. So bears with their first, the first time we've had consecutive closes all day today. 12, the bear bar closing near its low. I think 12 makes the market always in short, clearly for the first time today, or somewhat clearly. Maybe the bears need one more bar to make it clearly always in short, but you could make an argument for always in short on bar 12. The gap up and bar 1, so the market's been always in long, and you know that any bulls who are holding long through here will probably get out below 12. So I think it's reasonable to think that 12 makes the market always in short. Do you sell 12? I think you can sell it, but I think the problem is that you're selling right where bulls have bought pretty aggressively the past couple of times. So if you're selling for a swing. And what do you want to see if you're selling 12? Well, you want to see a bar like 19 immediately. You want to see a big dump in some sort of big bear move. But the other problem with that is that today was supposed to be a trading range day. I was expecting it because most likely not going to be a bull trend day. Because just look at the daily chart, right? We're so overbought that the odds of us just racing up and getting another big bull trend day are pretty low. But also, it's been so strong that I don't think we're just going to get a massive bear trend day either. So the bear swings are likely to be limited, and the bull swings are also likely to be limited, which makes the market a lot more sideways. 13, disappointing follow through for the bears who sold below 12, and then you get 14. You can see the bears who sold below 12 are disappointed in 13. They're buying back their shorts down here on 14. 14, an inside bar. You could argue a couple pushes down, 1, 6, 13, maybe a wedge. But there's a big problem with 14. If you're buying above 14, so I'll do this. The low of this trading range, right? The very low of this trading range is 14 or 13 low. This is what you can see so far in the day. And look at the exact midpoint. So if you're buying above 13 or above 14, you are buying the literal exact midpoint of the day. Is that really what you want to be doing on a trading range day, buying the midpoint? No, this is not a good place to buy. And that's what, a lot of trading ranges will trick you into, they'll give you a kind of good looking entry, but then you look and you're like, well, oh, this is the exact midpoint of the day. And I've been seeing that more lately. So really not that great, 14, because you're buying in the smack middle of a trading range. Better to wait for follow through. And you can see you got a disappointing micro gap down on 15 because not a lot of traders are taking it. Outside down 15. Now I think clearly always in short on 15 and okay to sell. Follow through 16 small, but a bear close. I think what bears just wanted there was a bear close. If we got any sort of bull close, they'd be too worried about a trap here potentially. Maybe we trade, if we got 16 traded down to the prior day's high and then a bull bar closing near its high. It might have been a trap, expecting to at least get back to the 14 high because it was a semi-reasonable buy, although not good, but semi-reasonable looking setup. 17, a doji bar, outside bar, just very sideways. Some follow through on 18, but look at this follow through if you sold 15, 16, 17, 18. It's really not all that great a follow through. So if you're short here, it's okay to be holding for always in short, but you have to be realizing that the downside is relatively limited today. Limited. Oh my God, I can't say that word. Downside is relatively limited today, and the upside is going to be relatively limited as well if we start to get a swing up because of the reasons I said on the daily chart. And then you get a big dump on 19, the remainder of bulls giving up, and essentially going to end up being a vacuum test of yesterday's close. Do you sell 19? I don't think so. This is a profit-taking bar. You're in a trading range and you get a gift in a trading range. I think you accept the gift and just take profits, and that's what causes 20. And something interesting happened. If you sold below 15, those traders around this low, I might be looking at the wrong. There was some 10-point scale. Oh, I was thinking of this, the 50, bar 50 sell. Traders made about 10 points. You can see on 59, they made basically exactly 10 points. And then we got somewhat of a reversal up. So never mind on that. But I actually think traders might have made 15 points, I guess, suppose. A little over 15, selling below bar 15. So interesting there. No quite 20-point swings unless you sold below 12. I assume you made 20 points, a little over. But big bear bar 19, I think you just take profits, and that's why you get 20, the small inside bar, because traders are taking profits. So you're getting not a lot of follow through. So if you sold close to 19, you have to ask yourself, why did I get bad follow through? If I thought it was so bearish, why is it not doing bearish things? 21, a bear bar, but closing around its midpoint, testing yesterday's close. And this was a big bull channel, and then we started a trading range. So it's very possible this is now the bottom of what is going to be forming a trading range. So potentially the whole trading range now is this. And you can see disappointment and bear. You know that the bulls who bought below 20 are probably going to make money. And what else do you know? Since it's a trading range day, right? Traders who did reasonable things and scale and lower are probably going to make money, which is why one of the reasons I thought we were going to get back to the 18 low. 19 was a surprise. And so usually, when you get those kind of surprises, you might retrace it. And I thought, a couple things. The 18 low was going to be a target. You can see we got there and sold off because the bulls who bought below here scaled in lower and then sold. And generally when you're starting to get this reversal up, you're looking at the high of the most recent sell climax, which is the 19 high. So the 19 high was going to be a target as well, and we tested it a couple of times. 22, it's essentially a micro double bottom with 21, but not closing very strong, not a great buy. 23, it's technically back to buy the close, I would suppose, but it's probably still always in short. Maybe some traders would buy it for a swing, hoping that we're going to get back to the 18 low, but the risk reward is not all that excellent for doing that. So I don't know. If you did that, you need to either be willing to scale in lower, which can be, potentially dangerous on something day like this. probably okay, but it's just kind of a hard trade. And then you get big follow through 24, trading ranges generally trap traders out. Disappointment 25, big tail on the bottom. But what did 25 do? As it traded down, you can see after traders got the confirmation they wanted 24, that the market was going in, probably to the 18 low, the market traded back down and gave them good risk reward to buy after this, knowing it's probably at least going to get a second leg. So even if we do go down, they can scale in lower. So traders bought at the market, causing 25, the rally on 25. 26, a second leg up from these three, and then disappointment on 27. Buying 26, probably not all that great because this channel is relatively tight. It's probably going to get some kind of second leg, though it could be later in the day. And, you're buying right on the moving average. So disappointment, 27. It's probably not a buyer. A lot of buyers will at 26. Follow through for the bears on 28, but it's not good. 27 was essentially a low one short after 5 straight bull bars. Not very good. 29, a bull bar, but a tail, and then follow through on 30. It's probably okay to buy 30. You can see how tight this channel is. We're probably going here, and we might have, you can see the bulls who bought below 14 did not quite get out around break even if they scaled in, and we're not able to get out of their first entry around break even. So I thought we were going to get back to the 14 low. We didn't end up doing it, but I thought it was reasonable to buy above 30 since this bull channel was really tight. And you could buy above 30, always in long, taking a chance we get back to the 14 low. Follow through 31, but a tail on the top. More follow through 32. Some sellers at the climax. And if you're long up here, what are you hoping? You're hoping for a quick pop to the 14 low. If you're lucky, the 14 close, but probably just the 14 low. And then you're going to dump your long. And instead, you get a doji bar 33, and traders just give up on the idea and they exit below 33, and that causes 34. I assume 34 pulled back. I don't know. I haven't looked, but I assume it pulled back to maybe 50%. Okay, so it looks like a little more. I suppose it depends what you use as 50%. But traders generally buying the moving average around here. And then an inside bar, 35. We'll probably get back to this close at some point. This is just not this is just not very good trading, though, for stop orders. 36, a potentially 2 legs down for the bears, and then a reversal up. 37, it's a high, high 1 or a high 2. I guess you could look at it 1, pause 2, or you could just look at it as, a high 1. But it's really not all that good. It's a bear close, big bar, big risk in the middle of a trading range. Bull bar 38, maybe it's always in long, but you can see disappointment 39. Bulls more interested in buying below 38 than above 38. 40, a bull bar, but not all that great. And you can see even, 41, disappointment. 42, bull bar. And now we're going bear bar, bull bar, bear bar, bull bar, bear bar, bull bar, bear bar. And then we get another bear bar on 44, but this moving average has been flat for like 20 or 30 bars. So really, you don't want to be doing anything in here when you're sitting on a flat moving average in the middle of a tight trading range. It's really not that good. 44, bear bar closing, kind of near its low, but even if it triggers, I don't think it's all that good. You need to wait for the follow through. You're selling the bottom of a tight trading range here. And follow through, good bull bar 45, and follow through 46, but now you're buying the high of this trading range. And there'll be sellers if we get to here, and that's not very far above. So your risk reward really isn't all that great buying up here. It's theoretically okay to buy the close of 46 or buy above 46, but I just don't think we're going that much higher. And you get kind of bad follow through 47. It's a bull bar, so you're thinking, well, it's not that bad a follow through, but it kind of is. If you're buying above 47 or above 46, you want something that resets the market cycle. You want a bar like 24 where you're getting swept into a trade that's going to be, you're thinking, oh, wow, this could be a really good trade. Maybe we're going all the way to the upside. Additionally, 90% chance every day that we break out of the 18 bar range, which we also did, but 82.5% chance that we break out of the 36 bar range, which we actually did not today. So, I thought that was always interesting. But so buying up here, really not as good as it could be. And that's why you get disappointing follow through 48, because no one really wants to buy this high, even though it's theoretically by the close, you're buying high in a trading range. Outside up 49, but not all that good. And then 50 was probably the best trade of the day. You can sell below 50. There's a lot of ways to look at it. You have top of the sell climax and a double top 38, 50. You could also look at it as a wedge. I generally see, there's a lot of ways to look at it. You can look at it as this is a sell off, and then you get 1 pullback 2, so 2 legs up. I don't know if they were even. No, they weren't. So 2 legs up, and then, essentially a big low 2 short below 50. That's probably okay. I've been looking at things as wedges a lot. So I thought, massive overshoot, but 26, 33, and then 49. I had a question yesterday about wedges, and they're, explaining it better. And I guess, it kind of, they're just hard to see, but, breakout points essentially is what you're looking at. Like I thought yesterday, for example, When we got this, I thought, well, we got a breakout above one, so that's potentially one push, a failed breakout here, potentially two, and then potentially a third failed breakout. So it could be three. But since this was so tight, it's probably going to be a minor reversal and a minor wedge. And so here, this is a much more crude wedge, but I think there are better ways to look at it, but that's just how I've been seeing things. This stock has a good example of a wedge on the daily chart. Like by breakup points, here's one, and then two, and then three. And right now, this is getting a breakout below the wedge. Al talks about, hodl trades, hold on for dear life. And this is kind of an interesting example of that, I think, where like if you're buying right now, you'll be in at $10, and this stock could easily go to zero. You could easily just lose all whatever you put into it, but it's not unreasonable to think that it'll get back up into this range, the 20 to 30 range. So I don't know, you're risking $10, on the chance that this stays in the trading range and this breakout below fails and it just turns into a really sideways, just stays sideways. So I don't know. I just think that that's an interesting stock. Kind of sold off in the end of the day. But anyways, so 50, I thought it was a credible sell, small bar, top of the trading range. A lot of times in trading ranges, it never looks that good, but it's also a smaller double top with 48 and 50, neckline 49. Follow through 51, but tail, so not as good as it could be. Disappointing follow through 52, a lot of times hard to hold in trading ranges. 53, again, a big tail on the bottom. At this point, bears are going to exit above pretty much any good bull bar. So bears are going to do their best to continue to get bear closes, even if they're not all that strong. 54, essentially a doji, kind of, again, kind of hard to hold, but traders it's a bear micro channel as well. And then you get a big bear bar 55. And what 55 did, if you sold below 50, you were able to make more than 5 points. And a lot of traders just took profits, and that's what caused the big bounce on 56. So me personally, if I had sold, I wasn't around, I was doing other things, but I think that selling 50 is a pretty credible thing to do. And I would probably just get out on the close of 55, to be honest. And then that's what causes this bounce on 56. And sometimes 56 will close in the middle of its bar and then start to rally, or it'll close on its high. And then you pretty much lose all of your profit. And, what are you thinking is going to happen if you're still short on 55? I mean, it's maybe, it ended up being one pullback, two pullback, three, and you got three pushes down towards the bottom of the trading range. But really, does this look like the start of a really strong bear breakout? Probably not. It just looks like a channel in a trading range. 57, a bear bar, but a tail on the bottom. And then 58, an inside bar, potentially a final flag. It's the third leg down in trading range. One pullback, two pullback, three. So, you can be short, but if you're short, you're kind of trading always in a trading range, which is the wrong time to trade always in. Bear bar closing near its low, 59. And, bears want a big breakout and a collapse into the end of the day. But again, I think because of the daily chart, a lot of that is probably limited. Any bears who did sell were disappointed in 60, and they just got out around break even. And that's why you got this big bounce in 61. And that's kind of the problem that I was talking about here. It's like if you're selling down here, when it starts to bounce, if you're waiting to get out above a bull bar, then you're going to end up you're going to take a much bigger loss than you would generally like to. And then you get follow through 62 for the bulls, disappointment 63 inside bar. Second leg up here, and then a big bear bar closing near its low. This, at this point, is just a tight trading range. None of this is really all that good. This is a low 2 at the top, but it's really not all that good. That 68 was big enough for a second leg, and you got it. And then a reversal up 73, but it's all in the middle. And it's all on a flat moving average. For stop orders today, I guess if you can make quick decisions, 12 is probably fine. 15 is fine. You could probably sell below 16 too, since it's technically still always in short. 30, taking a chance and then just get out for always in at least. 50. Something to think about. It's less applicable on days like this, but if you saw 50 and you're thinking that's a really good trade, that's I want to sell 50, but you hesitate too much, and then 50, you see 51 close down here, and you think, God dang, I missed it. If you would still be in the trade, so you just say to yourself, well, if I had sold 50, would I still be short after the 51 close? And if the answer is yes, you can just sell at the market. The better example is on trading range days like that, or trend days like this, where let's say you were staring at this bar and you really wanted to buy it, and then it ends, but you didn't, and you sat out, and then you get this. What you can do is, when you see this bar close, you're thinking, oh, well, now I've missed it. But then think to yourself, if I had bought this, would I still be in the position right here? And if the answer is yes, then you just buy the position back, You just buy the position at the market. And you can even, if you sit there, and even if it's all the way up here, and you're thinking, well, if I had bought this, I'd still be in, then you can just buy at the market up there. Buy small. It'll be fine. On the daily chart, we're at the top of a channel for the bulls. So we're probably going to get a couple legs sideways down, I would imagine. It's theoretically a sell for the bears, betting that this breakout's going to fail. I think the bears who sold above this high are probably going to make money. So we'll probably come back down to at least right here. I don't think those traders will remain trapped. But it'll be interesting on Monday to see what happens if we get any follow through below this low. Low probability of just like a plunge tomorrow. But we'll see what happens. And you can see traders created a bit of a tail on the weekly chart. So probably getting back to this high next week, I would imagine. And the bears are going to try their best. It's the last week of the month next week. And I don't even think it's for the whole week. Yeah, it's not even for the whole week. First 4 days. So bears are going to try their best to get some sort of dramatic reversal down to make this bar disappointing, but I'm not sure how good they're going to do. This is pretty strong, and we're probably going higher. Yeah,